15 minutes could save you more than just money on car insurance. This is Industry Focus. Welcome to the Financials edition of Industry Focus. I'm Christine Hargis, and today we're going to find out from the Fool's senior banking expert, John Maxfield, how to dig into a bank stock the easy way in 15 minutes or less. So John has spent countless hours analyzing banks, and from this wealth of experience, he's been able to distill bank analysis down to just 3 key metrics that you can use to find out if a bank you're looking at is a good investment. And if you're thinking that this is too good to be true, consider the industry that we're talking about here. All banks really do, at their core, is borrow money at one interest rate and lend it out at a higher one, and they pocket the spread. So because banks share such similar business models, the beauty of the industry is that once you can analyze one bank stock, you're pretty much set to analyze them all and make meaningful comparisons too to help you choose the best of the best for your investment money. So without further ado, let's dig in. John, from what I understand, the first piece to this puzzle has to do with protecting yourselves from losses when things take a turn for the worst. So how can investors safeguard against losing all of their investment or close to it in banking panics?
So the important thing to keep in mind whenever you're investing in banks is that, to your point about banking panics, if you go back and you look at the history of banking, the banking industry, more than probably any other industry, is really susceptible to these infrequent, intermittent panics that cause a whole bunch of them to fail, or if they don't fail, to egregiously dilute their shareholders. And so you want to, when you're picking a bank stock, the very first thing you want to do is just do a temperature check to make sure that the bank you're looking at is not susceptible to that. And the easiest way to do that is just to look at its return on equity, its annual return on equity over the past, say 10 years. Pick out the lowest return on equity, the lowest annual return on equity. If that number is negative, it means that the bank took relatively large losses in the financial crisis. If it took large losses in the financial crisis, it means that it probably, in some way, either underwrites bad loans or takes bad assets onto its balance sheet, and you definitely want to avoid that.
So how do you go about calculating that number?
So the return on equity, there's a couple different approaches you can take to this. First, return on equity, because it's such a common metric, you can just go into a bank's regulatory filings, either 10Q, which is their quarterly regulatory filing, or their 10K, which is their annual regulatory filing, and you can find all this stuff on the SEC's website, particularly the EDGAR database. So you can go in there and just look at their return on equity. Or if you wanted to calculate it yourself, what you do is you just take their annual net income over any given year and divide that by the amount of shareholders' equity, and that'll give you how much they're returning based upon the capital that's invested in the company.
Great. And what are we looking to see here? What's considered, in the long run, kind of solid?
So over the long run, as a general rule, what you want is you want a return on equity in excess of 10%. I say that because in the bank industry, it's generally assumed that common capital costs roughly 10% of your equity. So if you want to be moving in the positive directions in terms of your earnings relative to the actual expense of the money that's invested, and when I say the expense of the money invested, I mean the opportunity cost associated with investing in a bank relative to investing in bonds or any other type of investment. If you want to be above 10%, and if you're a really good bank, a U.S. Bancorp, Wells Fargo, an M&T Bank, and you're a community Bancorp, you're going to be up in the 15% range.
And yet, in this 15-minute analysis, what you would recommend is looking for that worst year?
That's exactly right. So that's for the first step. So that is just making sure that you're not going to get yourself into a situation where in the next downturn or financial panic or whatever it is, you're not going to regret the decision of investing in that particular bank.
Right. And even if you have been experiencing pretty good returns during normal times, all of a sudden, economy takes a turn for the worst and you see your entire investment getting washed away. So, right.
That's exactly right. And even more to that point, Christine, is that when the economy is going really, really well, the poorly run banks actually have a tendency to generate really high returns on equity because they're underwriting a ton of loans, many of which are eventually going to will eventually go into default when the economy turns against the bank. Just by looking at, the top line return on equity, how high it is over a given time period, isn't going to tell you as much as looking at the bottom line.
Sounds good. So there's step one, identifying the lowest annual return on equity since 2008. So the next step in your 15-minute analysis is taking a look at how disciplined the bank is and how much of its revenue gets washed away by expenses. John, how do we get a feel for this?
So there is a metric in the banking world. It's called the efficiency ratio. And what the efficiency ratio does is it just tells you the percent of a bank's net revenue that's consumed by operating expenses. And you're going to want to see that figure be in the 60% range. Ideally, quite frankly, with a really good bank, you're going to want to see it below 60%. But if you have a bank that has an efficiency ratio that's above 60%, so let's say a bank's efficiency ratio is 75%, that means that only 25% of its revenue is left over to pay taxes, distribute, to take care of dividends to preferred shareholders, and also to take care of loan loss provisions. That's going to leave very little income left over to actually be to accrue to the actual common stock shareholders. So you want to see that efficiency ratio relatively low in order for a bank to be highly profitable. And if a bank is highly profitable, then it's going to compound its earnings at a very rapid rate. And assuming that they are good about their risk management, it'll do so over a long period of time.
And it seems like this is all kind of tied together by the concept of discipline.
That's exactly right.
So which banks have the best efficiency ratios?
So, your general banks that have great efficiency ratios, I've already mentioned them, Wells Fargo and U.S. Bancorp. U.S. Bancorp is pretty consistently in the mid 50% range, 55%, a little bit higher. It's trended a little higher over the last few years just because we have higher regulatory compliance costs as a result of the increased regulations since the financial crisis. But you also have a bank like New York Community Bancorp, which its efficiency ratio is often in the 40% range, between 40 and 50%. But that's just because of it's got kind of a unique business model. But those are the banks that are really disciplined, not only at expenses, but and this is something we've talked about in the past, but also writing good loans. And there is a connection there because it takes discipline to do both.
Right, and so you get that positive feedback loop where banks with lower ratios are already more profitable, so they have less incentive to make these kind of questionable loans just to stretch out their yield.
That's exactly right. That is exactly right. And if there is one thing, Christine, that bank investors should keep in mind, it is that relationship between a bank's efficiency ratio and its tendency to underwrite either good or bad loans.
All right, so that's a very important step 2 then, your efficiency ratio. So step 3 is all about profitability. John, what is our last metric to look at?
So the last thing you're going to want to look at, so after we've gone through and we've temperature checked the bank to make sure that it has probably a good chance of making it through the next crisis in good shape, not even thriving during the next crisis, and then making sure that just as a general rule, it's a relatively highly profitable bank because its expenses take up a relatively small proportion of its net revenue, then you're going to want to swing in and to see how it's doing on the sales side. And to determine that, you're going to want to look at its top-line revenue. And there's a number of ways that you can look at it, but how I like to look at it is you want to see a top-line revenue figure that's somewhere in the range of 4.5% or greater relative to its assets.
So why 4.5%?
Well, if you go through the math, so earlier I said that, a bank is going to want to earn, let's say, a 10% return on equity just in order to cover its cost of capital. So if we can start there and then kind of work our way backwards. So because banks are leveraged by a factor of 10 to 1, that means you're going to want to earn about 1% on your assets. So then if you take into consideration that you want to get your net income to be about 1% of your assets, and then you have to start backing out your expenses, which let's say, there's 60% of your revenue is consumed by your expenses, so that's going to increase how much revenue you're going to need relative to your assets. And then you got to take into consideration taxes and loan loss provisions and then payouts to your preferred shareholders. And just once you take all those things into consideration, just the math works out that you need 4.5% or higher in order to generate at least a 10% return on equity.
So that makes sense that you're starting with the 10%, you're considering a leverage factor 10 to 1, that gives you your 1%, and then you take your efficiency ratio and say that because you do have all these costs, you want to see revenue up there in the 4.5 or greater range. But how do you get that 10% to start with?
So the 10% is, the terminology is used in the bank industry that your 10% is your cost of capital. And what they mean is that even though when you think of equity capital as, when you look at a bank's income statement, equity capital doesn't actually have an expense, right? It's not like you're paying interest on it. However, the way the banks look at it is they kind of impute the cost of capital. They say, look, we have to earn a certain amount of money in order to attract investors to invest in our stock rather than, say, bonds, other stocks from other industries, and that type of stuff. And what kind of the industry has settled on as that return on capital or that return on equity being is right around 10%. To where over the long run, the bank industry at that rate can sufficiently attract the equity that it needs in order to do what it does.
Okay, so it's kind of like a theoretical interest to shareholders just so that people don't sell all their shares and cause the price itself to drop?
That's exactly right. It's an imputed cost of capital. So it's not like actually a cost of capital. It's just imputed.
Okay, great. So there we have our 3 steps. The one thing that's kind of left on my mind, though, that we haven't really touched on within those 3 steps, what about valuation? How do you know that even if a bank passes the test on these 3 metrics, you're not paying too much?
So that's a great question. Valuation is tricky, when it comes to any type of stock, and banks are no exception. The problem is that, right, if you have a bank that has great credit discipline, great expense management discipline, and it also has good revenue generating abilities, it's going to trade at a high valuation relative to its book value. So in the bank industry, the saying is you want to buy at half a book value and sell at 2 times the book value. But the reality is that if you're going to invest in banks, you only want to invest in ones that are stable, that you can trust to make it through the next crisis, and those are good banks. And it's unheard of when a bank like U.S. Bank or Wells Fargo is going to trade at half the book value. So if you're going to buy bank stocks, you're going to have to pay up in your valuation. But the one positive thing about that is that good banks, if you look at, say, a U.S. Bank where that trades for about 2 times book value, if you look at a chart of its valuation over years and decades, it's always traded at a relatively high valuation. So it kind of takes care of itself. It's not like you're buying at 2 times book value, then it's going to fall down to 1 times book value. Good banks traditionally stay right around, that 2 times book value rate. So you just have to, suck it up, go with it, buy the good bank at a high valuation, and just assume that's going to compound at a high rate, which it should do, and particularly relative to kind of their less their less well managed peers.
It's a very foolish answer, John, since, of course, we do advocate at The Motley Fool buying and holding for the long run. So with that...
and that's the thing. The one thing that we know is that if you hold stocks, good companies for a very long time, even if you overpay for a little bit, you're still going to generate great returns. And that's why Warren Buffett, one of his famous sayings is, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price.
That's an awesome way to close out the episode. Thanks, everyone, for giving us your 15 minutes today. And John, thanks so much for sharing your awesome framework. Of course, picking out a bank that you can really stand behind buying shares in will likely take you more than 15 minutes. But I know I was surprised to hear just how much I could learn about a prospective bank stock in just these 3 easy steps. So what banks are you guys going to try it out on? What's on your mind? Let us know at industryfocus@fool.com. We love hearing from you guys, and we're happy to answer whatever questions you might have for us. And until next time, have a great week. Fool on. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear.